Vinay Jaising, CIO and Head Equity of Advisory at ASK Private Wealth, joins us right now on the show. Vinay, always good talking to you. No different today. Thank you for taking the time out. How are you guys thinking of this whole issue, especially from today morning onwards, now that we know that 50% for now seems to be a done deal?
So, a couple of things. First and foremost, very clearly, we knew that, India is not going to break its tie-ups with Russia. And, we can spend a few minutes on discussing why. We think Russian crude is very important for India. But so we were quite clear that, India won't break its tie-ups with Russia. Second, we realized that as tariffs come more and more into the country from US, India has to look, or we as investors have to look a lot more at the home bias part of it, which is as against looking at buying the dollar or buying companies which earn in dollars a lot more. It's the domestic market we are a lot more robust or positive about. The good things are very clear. The DXY has reacted negatively, which means the dollar is set to get weaker. It has not happened against the Indian currency so far, but it's happened against the European currency. And also the second good thing is the VIX, the Indian VIX is about 11.5 to 12, which is a very good number. Anything below 18 is great. 11 to 12 means the market is not volatile. Even the US market at 14 is not volatile. So we're not sitting with too much of cash on hand. We just tweaking our portfolio to make it a lot more home bias as compared to, looking at a lot more dollar plays, which we would have probably if we thought that the dollar was going stronger. Our firm view is the dollar is going to get weaker because of US-centric issues on their balance sheet, and interest rates would come down in US, and that would lead to even the rupee getting a lot more firmer. So our home bias view is maintained out here.
Right. So Vinay, with everything that you said right now as well, yes, a weakening dollar is something that you're looking at, but the tariffs are a challenge when you talk about the Indian exporters as well. And the key over here is the kind of pivot that will be needed, probably diversifying into other export markets if needed, or even focusing on the domestic markets as well. With this, your Make in India plus China plus one strategy is something that also sees a significant headwind. How do you think will this, slow down the momentum of global companies as well coming and setting up bases in India, and in turn impact the overall outlook?
It's an amazing question. So think of it this way, right? If earlier we would have said just buy any company which was into exports in the country where you had a competitive edge, now we're going to say buy those companies where you can see a bilateral treaty between India and the rest of the world. So let's say if you can see in textile, a treaty between India and UK, look at some textile companies out there. In the pharmaceutical and chemical space, if there are some exemptions, not for the formulators, not for the higher end products, but what you make in bulk drugs or APIs or CDMOs, which are based in India, which are selling to US, which have an exemption, look at those. Look at those companies in EMS or manufacturing, which are giving you a domestic bias, replacing US products coming into the country. So that's where our Make in India story would emanate into. Firstly, where there is a bilateral treaty between India and the rest of the world, and I think UK is one prominent region, and that's textiles. Just repeating. Secondly, look at those manufacturing PLI stories, which are selling a lot more in India and replacing global products. And third, if you are looking at US, look at not the higher chain where you could get tariffs coming, but where you're getting exemptions. And exemptions could be in certain pharmaceutical or chemical spaces, certain pharmaceutical spaces. Look at those, but they could be lower rung. They could be the CDMOs, which are supplying to the CVSs of the world, where the brand is probably that of a CVS, but the product coming in is from India.
Right. Vinay, would you consider another aspect where companies are saying that they would probably look at shifting their manufacturing base to countries with lower tariffs as well? If I know it's not something that will be immediately into effect, will take some bit of time. Do you think that consideration would be a good one from corporate India?
So I would put it the other way around. I'll just retweak your question. Our analysts, both in textiles as well as in CDMO or pharmaceutical sector, are looking at companies where there is not one manufacturing base. Let's take an example. Let's say first of the pharmaceutical space. Suppose you're a CDMO and you have operations in India and in UK. Now, if you have operations in UK and UK has a tariff which has been hurt by US, you transfer those production as long as it's fungible to India and vice versa. So you will see a lot of these shiftings which may impact a quarter for these pharmaceutical companies, but they'll come back in base. But to put up a factory, it'll take a couple of years or maybe 2 years to stabilize. That's a lot more dangerous. Similarly, in textiles, we are looking at companies which don't have one factory, but probably three, four, five factories. So whatever you were doing earlier from India, selling it to US, you'll probably sell it from Bangladesh to US. And India's assets, so whatever India produces would go to, let's say, UK. And that's kind of companies which we want to buy, which already have assets of factories across the globe where they can be fungible as well.
So, Vinay, how do you right now advise on portfolios? Try and sit on a bit of hedge, try and make it domestic centric because that's a hedge enough. How does that work? Part one of my question is that. Part two of my question is, should portfolios position themselves for a potential return of FII flows at some point of time in the year if this issue gets resolved? Because when FIs and DIs both compete with each other, the tape really moves swiftly and you don't have the ability to buy.
Again, very, very interesting questions. If I can take your second question first. If we were to turn back the clock by 20 years, the currency was 30 to 35. The currency has moved up by as much as almost 2.5 to 3 times. So even if the market made a 5-time return, the 3 times part of it, the FII did not get back, and which is why, let's say over a decade, the overall FII ownership peaked at about 20% and is now sub 16%. With my previous comment which I made, the DXY is getting weaker because of US-centric issues and the dollar gets weaker versus the rupee. What you may see is what you saw in April, May, June. In April, May, June, you saw a lot of inflows of FI come into the country. And as inflows of FI came into the country, you started seeing a lot more robust market. But in the month of July and first half of August, whatever $4.5 billion which the FI has got into the country, they took back. So now it's a big fat zero. The net FI flow which has come from April 1st. That number, according to me, is certainly going to change, whether it's 3 months, 6 months, or 12 months. India as an economy is doing exceptionally well. The crude environment is relatively weak. The advantage which we get from Russian crude consumption is as much as close to $5.5 or $6 billion in dollars, but it also saves us forex reserves. So forex reserves itself is very, very high. The Indian government has done what it takes to one of the weakest elements India had, which was consumption. They've tried to they've tried to restructure the entire GST, in the last 8 years. This is the first time there's a massive change. You're making it into 2 slabs. You're trying to make products cheaper for the masses. And probably the syntax products may be a little more costlier. So what that means is the inflation levels too would go lower, which already I think the inflation levels are low in the country. Now, keeping that in mind, that means probably real interest levels are high and that can come down as well, which means the cost of capital for India is coming down, which is all a very bullish signal for the Indian markets to do well. Indian earnings is the second part which is missing. But I think what you may see is in India, or the government starts focusing enough on capex, which they've promised. Consumption, they've already given a lever. You've seen the rains come up a little earlier than required. So rural India will start ticking. The question is whether consumption starts moving faster. And I'm hoping the cut in taxes and GST does it. I think India is looking into a very sweet spot, 1 year of almost time correction. And now, your earnings last quarter grew by 6, 7, 8%. Can they grow by 10 to 15%? Or can you look at stocks which are growing at 15% and make your own portfolio? I would come in that. And I think potentially FIs would look into that and come into the country. Again, timing, I am not very clear when that would happen. I was hoping that it happens by April, May, June. I've got surprised because of what's happened in the tariff. This negative news has clearly made India the worst performing market in the last 3 months. On the hedge, just at the cost of being a little repetitive, I would play two baskets more than three. The first is the financial and consumption basket. The second basket, which I would play, is the capex basket, which are cement companies, which are infrastructure pipe companies, tube companies, power companies. I would play that asset class a little bigger. In terms of Make in India, as I said earlier, I would look at those names where there are multiple factories in the country which are having bilateral treaties in those regions with the countries where they are exporting their products, and that could be a win-win situation. But I don't think I'm going to sit in much cash because India has had a time correction in the last 12 months already.
Interesting take. Time correction for India. Two baskets that you're looking at, consumption, BFSI, and the capex theme that Vinay would be playing out. But thank you, Vinay, so much for joining us on the show and sharing your views. I think, in spite of all the concerns, Neeraj, the last couple of market guests, fund managers, CIOs, we have spoken to, there is one common commentary that's coming in, that no one is negative India from a long-term perspective. They are seeing that reset which is happening as well. In spite of valuations being lofty, in spite of valuations, if you have to compare to peers, we are on an expensive path. The expectation was that growth will slow down, but now there are signs probably there will be a pickup, and I think that's what is keeping everyone really positive when you talk about consumption and BFSI space, because both of them tell you the domestic growth story. And when it comes to capex as well, that's an addition that Vinay is actually making today.
Yeah, well, let's see if that growth, the elusive growth, comes back or no. But GST